which was in the peak time, all of that. So I didn't really get that.
Because all the trades has to happen. Take the data from those sites. We have to review the data. We have to check the data. We have to analyze the data from those websites only. So that is
Okay.
those two sites are basically the encyclopedia of trading and investments.
Okay. And sir, you had sent me a link of that Kotak Demat account.
You
I
can
got it. I got it done, sir. And I mean, they told it will take some time for verification.
1 to 2 days they will open it and they will share you the details, username and password about that.
Okay, sir.
Okay. 1 second.
Yeah, sure.
So do you know about the finance rules?
Finance rules. No, sir. It was there in that NSC. This one.
No, it is not there in that site. But there are certain rules that you should remember. I'll just share my screen. You
Yeah.
can note down those things because it is important to remember that.
Okay, sir.
Okay. So these are basically the 9 personal finance rules that everyone should know and everyone should try to follow it. Right.
Okay, sir.
Whether as a child or as an adult or whoever it is, he should try to follow these rules, right? So first rule is about rule of 72. So what rule of 72 says that how many years it will take for your money to get double, right? In how many years your money will be doubled based on the interest rate or based on the return you will get from different asset class, whether you are getting it from FD or you are getting from stocks or you are getting from mutual funds, whatever it is. So the rule of 72 says that the formula is 72 divided by the interest rate. Okay. So means if a specific asset is giving you a 8% of interest rate per year, then it will be like 72 divided by 8. And how much it will be? 8 9 is 72, right? So 9 years,
Yeah.
9 years it will take to double that money. If you have invested 1 lakh in a
Okay,
fixed,
to double that.
uh,
Okay.
so 1 lakh will become 2 lakhs in 9 years. Okay.
Okay.
So same thing if you see from the stocks perspective, normally the minimal return is around 12 to 14%, which is the safest return every year from the stocks. And if you think about the mutual funds like that, then in that case you can consider like 72 divided by 12. So that will be around 6 years. So your money will be doubled in 6 years. So
No.
this is how you can calculate, based on your goal and target, you can calculate how much your money will be after certain number of years, right?
Okay.
Let's say after 4 years you plan to have like 5 lakhs of money or some goal is there in your mind, and so based on that you have to start the investing based on the return you are getting from that asset class. So this is how you have to plan.
Okay. So the current rate is 12 to 14%.
Normally, which I have seen based on the historical data and all, from past 20, 25, 30 years like that, I have seen that the mutual funds or the stocks which are large cap, right? We spoke about the blue chip stocks, na. So those stocks normally give 12 to 14% return per year like that. Okay. So
Yeah.
you need to remember this formula. Whenever you are planning to find your goal or target, so you can use this formula to calculate those things.
Okay, sir.
Okay. Second rule is rule of 70. So this rule of 70 says that based on your inflation, how soon or how long it will take to half your money. So this rule was to double your money, right? So and this rule is like
Half your.
it will take to half your money, right? Because it's based on the inflation and all, right? So like rule of 70 means 70 divided by interest rate means if you are investing in a FD gives around how much interest? 6 to 7%, right?
Yeah.
So you have to divide 70 by 60 and based on that you will get the number of years in which your money will become half. Half means the money will remain same only but the value of money will become half, right? Let's say the value of money 5 lakhs right now, okay? And you have invested in a FD which is giving 6% of interest every year, right? So 70 divided by 60, how much it will come?
Around 9 something.
9 years, right?
Yeah.
Not 9 years. Actually, it is 6 now. Approximately 11.5 or something like 12, right? It will come like that. So in 12 years, the value of 5 lakhs will become 2.5 lakhs. Means whenever you are going to spend in the market based on the inflation, it will, let's say something you are, let's say you want to buy a flat right now, which is costing around 20 lakhs, right? Okay. Then after 11.5 years, that flat will cost you 40 lakhs. The value is increasing in terms of asset, but in terms of money, the value will decrease.
Okay.
You have to spend more actually to buy, if you want to buy anything like asset or flat or if you want to see the fees structure, right? All those things, the money, the value of money will become half.
Okay.
You have any idea about inflation?
A bit, sir. I mean, like inflation where the currency price goes top and so does all the economic things go top, like groceries, all of it also.
Inflation is basically a general increase in price and a fall in because these two are inversely proportional. Once the inflation goes, the value of money will decrease like that, right? So here also we are considering the inflation in the formula. It is not showing you, but based on the inflation, this will decrease your money, the value of money, right?
Yes, sir.
Right. Fine, this is clear now. Any doubt in this?
I got that rule of 72 perfectly, sir, but not this rule of 70.
Okay, let me explain you with an example. One second. Okay, so let's say right now you are spending 1,000 rupees per day on some kind of items like grocery or like to buy something else, right? Like daily items. Okay, so this rule says that after that much of years, you have to spend 2,000 rupees per day because based on the inflation will increase, right? So based on that, you should be spending double of that money after 10 years, 5 years or 10 years. So that means the value of money is decreased, right?
Yes, sir.
Earlier you were using 1,000 rupees to buy the same items and after certain years you are using 2,000 rupees to buy the similar kind of items, right?
Yes.
So that is why you should invest in a place wherein you are getting a return more than inflation.
Okay, sir. Got it.
So let's say currently if the inflation price is, let's say, 6 to 7%, then you should be investing in an asset which is giving the return more than that. Then the value of money will not decrease. But if you are investing in an asset which is giving you less than inflation, then the value of money will decrease. So it works like that.
Okay.
Now is it clear, or still you have some doubt in this?
Yes, sir. I got it.
Right. So it is basically like both the rules you should remember it. Okay.
Okay.
Third rule is 4% of withdrawal rule. So this says that withdrawing 4% of your retirement savings annually, right? Annual withdrawal should not be more than 4% of total savings. So let's say you have some lump sum money of 50 lakhs, okay?
Yep.
And the person want to retire. Once the person retires, he doesn't have any other income, right? So he want to generate some income from this corpus only, right? Because if he doesn't invest, then the value of the money will decrease, right? So he has to
Yes, sir.
invest somewhere wherein he is getting more rate of return. So let's say he has invested 50 lakhs in some mutual fund which is giving 12 to 4% of return, okay, per year. So the maximum money he can withdraw every year is 4% of 50 lakhs.
Okay.
So if he withdraws 4% of this money, then your return will reduce, right? Because here you are getting 14%, and now you are withdrawing 4%. Now your return will reduce to 10%, approximately like that, right? So you should not withdraw more than 4%. So this rule says like that. So 4% will be approximately 2 lakhs, right?
Okay.
Fine. Next is 100 minus age rule. So
What if we more than 4%, sir?
You can withdraw it. That is fine, but the money will not increase like that, because if you are withdrawing, let's say 10%, then your money will grow only at the rate of 4%.
Which is very less. Okay.
It is very less, right?
Okay. So withdraw 4%.
Because you are not able to beat the inflation at 4%, right?
Okay.
Inflation is 7%, right?
Okay, got it.
So that is why this rule says that you can withdraw only 4% of 4% part of that income
Annually.
Right?
Yes, sir.
Okay. So the next rule is 100 minus age rule. So this rule says you like how much percentage you should invest in equity. So what is equity? Stocks, stock market, mutual fund, like that, right? So there are two types of things. One is equity, other is debt. So debt is like basically the government bonds or corporate bonds in which the risk is very less. So they are giving you a specific fixed rate of return like FD, right? 6%, 7% or 8% like that. But equity returns are based on the market condition. If the market goes up, equity will give you more return. If the market goes down, equity will give you less return. So it is totally based on the risk and reward thing, right? So this rule says that based on your age, you should invest certain percentage in equity, and remaining percentage you should invest in debt fund, right? So let's say this says that 100 minus age. Okay. So let's say your age is 25 years. So 100 minus 5, 75. So whatever money you want to invest in the market, 75% of that money should go in stocks or equity.
Okay.
Let's say you want to invest 1 lakh. So 75,000 should go in equity, and remaining 25% you can put in debt fund or savings account or FD, something like that.
Debt fund means we are giving debt for...
No, it's not like that. Debt fund means they have certain kind of bonds, government bonds, corporate bonds, and all those. It is similar to fixed deposit.
Okay, they'll give you a certain rate of interest every year.
So that I will show you later, like how many types of bonds are there. But you can just now for consider like this certain percentage. Neha, वो चाबी दे देना. Okay, this is clear.
Yes, sir.
So let's say if my age is 45 years, right? So 100 minus 45, 55%. I should not invest more than 55% in equity.
Okay.
So this rule you can remember, because see the lesser is your age, the more risk you can take. The more is your age, you should take less risk, because as I told you that stocks are very risky. It is based on the return is based on the market condition. If the stock market goes up, you will get good return. If the stock market goes down, you will get less return, right? So the risk will be more.
Okay.
So based on these rules, some people will do financial planning. See, if some persons will come, they want to do financial planning, right? So we have to use this rule also while doing the financial planning of a person.
Okay.
Right. Then is 10-5-3 rule. So this rule says that 10% of equity provides expected returns for different asset classes, right? So this says that 10% of the equity, 10% of return from equity, 5% return from debts, and 3% from the saving account. So this is what the minimum returns you should get it, right? So this rule says that. But I am talking about 12 to 14%. I was talking about 12 to 14%, right?
Yes, sir.
So that is a maximum, but this 10% is the benchmark.
Okay.
Yeah. So this 50-30-20 rules. So this is like 50% you should spend on needs, 30% on wants, and 20% on savings. Next is 6x emergency rule. This is basically for the emergency fund. How much fund you should save it for your this thing, right? So this 6x means 6 times your salary. Whatever money you are earning from salary or from anywhere, you should have the 6x of that particular amount in your emergency fund. Okay.
6 times of that salary amount in your savings fund.
In your emergency fund.
Emergency fund. Okay.
So that means 6 months at least.
Okay.
Indirectly, you can say that 6 months of the fund. Let's say if you are earning 50K per month, right? Then you should have 50 into 6. 3 lakhs in your emergency fund.
Okay.
Then is EMI rule. So this rule says that keep loan EMI under 40% of your income.
Okay.
Some people will take more percentage of EMI and they don't follow this kind of rule, right? So based on this rule, you should try to take the EMI considering this rule. Let's say your income is 1 lakh, so your EMI should not exceed 40K.
40,000. Okay.
Life insurance rule. So this is get at least 10 to 15% coverage of your annual income. If your annual income is 10 lakhs, then you should take a insurance of 10 lakhs into minimum of 10 years. 10 lakh into 10.
Okay.
So these things are very important. Once you start your job or once you start your career, you should remember these. And these rules will keep on coming in your life once you start your career.
Okay. Sir, and regarding that emergency rule, initially when we start earning, how will we have 6x? I mean, 6 into
6 times. So let's say, see, you can do it slowly, right? Once you start your job, after 1 year, you can try to do it, right?
Okay.
Let's say at the start of career, you have started earning 50K, okay, 50K per month. So emergency rule says that 50 into 6, 3 lakhs, right? So you can start saving some money from the start, like 2,000, 3,000, like that, slowly. And after 2 or 3 years, you should have that much of fund with you.
Okay.
Like that. So these rules will help you from the starting of your career till your retirement age.
Okay, sir.
Clear? Any doubt in any of the rule?
Sir, I am not sure the 10-5-3 rule, sir.
So that is mostly not used, but this provides expected return. So this is like a benchmark they are talking about. See, whenever you keep money in savings account, you will get 3% of return. Whenever you are keeping the fund in debt funds, they will give you minimum 5% of return. And if you are keeping in equity, you should expect minimum 10% of return. So this is a benchmark they are talking about.
Okay. Minimum which you're supposed to get back.
You should get it. See, you should not be investing in such equity wherein you are getting the return less than 10%.
Okay, sir.
Fine.
Got it.
Let's come back to our slides. Okay, so now we have stock markets. In the stock market, we have basically three types of conditions. Okay, there are three types of conditions in stock market. One is called as bull market.
Okay.
Bear market.
Okay.
And there is one more which is called as sideways market, which is basically a mix of both bull and bear. Okay. So bull market means that the market will keep on rising, right? This is called bull market, or we call it as a uptrend also. Sometimes we call it as a uptrend also. Okay. Bear market is something like which is continuously keeps on going. This is called as downtrend also.
Okay.
Means something is of 100, if some equity is of 100 rupees, after some time like 3 months, 6 months, they will become 120. They will keep on increasing, right? The value of the will keep on increasing. That is called bull market. Bear market is the value of equity will keep on decreasing. Like from 50 to came to 30 rupees or 20 rupees like that.
Okay.
And sideways is like it's a kind of range wherein market forms. Let's say the range will be like 100 to 70. So this can be any range. I'm just giving you an example. Let's say a range of 170. So any of the stock can form a range like this, and it will keep on consolidating in this range for longer duration, maybe 3 months, 6 months, 9 months, or 1 year like that. Right? So this range will change based on the stocks. This will not remain same for each and every stock. Let's say a stock is of 500 rupees, then the range is different. The stock is of 50 rupees, the range may vary.
Okay.
So there are three types of market conditions and three types of traders also in this market. This is bull trader, this is bear trader, and this is like a mix of both bull and bear trader.
Okay.
Fine. This is clear. Any doubt in this? Three conditions.
No, sir.
So normally bull market we can define with the green thing. The bear market will be in red, and it will be sometimes it is green, sometimes red, sometimes green, sometimes red.
Both.
So both.
Okay.
So why we should invest or trade in stock market? We should start with a small fund. Okay. So now since you have opened your Demat account, so once it is opened, you can put some money in that so that we can use that money for some kind of trading, maybe 5,000 or 6,000 like that. You can keep it in that. So we have to see the minimum time of trade. We have to see the stocks which are highly liquid. Do you have any idea about high liquidity?
No, sir.
See, liquidity means that you will be able to buy and sell very easily. This is called liquidity, right? Let's say you have a land or a flat, right? So whenever you want to sell that land or apartment, it will take a lot of time to find a buyer, right? It is not that easy to sell it, right? So that we call it as a less liquid asset because it is very difficult to find a seller when you plan to buy. But in the stocks also, there are some stocks which are less liquid, means they have less number of equity, less percentage of equity in market, right? Let's say a company has 100% of equity and they have sent only 10% of the liquidity in the market. 90% are remaining with the promoters only, right? So these stocks are very less liquid.
Okay.
So you will find difficult to sell it because only 10% of the stake is there in the market.
Okay.
And some stocks which are highly liquid, maybe the promoters are keeping 75% with them and 25% are in the market, right? So
Okay.
in that type of scenario, you will find it easy to sell the stocks, right? So that is why we call it as we should choose the stocks which are highly liquid.
Okay.
It's clear now? Liquidity.
Yes.
Fine. Next, user-friendly operations of stock market. So this is like just talking about the how to handle the demat account, right? That we will talk once your account will be opened. Okay. So shares. So as I have explained to you earlier, that share capital means that 100% of the equity is there and they are sending 75. They are keeping 75% with them and 25% they are sending to the market. So this is called as number of shares. So 25% means, let's say they are 1 lakh of shares. So total is 1 lakh of shares. So 25% of 1 lakh means 25,000.
25.
So means 25,000 of shares are there in the market to buy and sell it. Okay.
Okay.
And then we have the shares, and then there is a thing called price, right? Like you go to market to buy fruits and vegetables. For every fruit and vegetable, there is a separate price, right?
Yeah.
So same thing for every stock, there is a price. And every stock there will be a different price, right? So that is called as price into, if you multiply price and number of shares, you will get the total company's capital.
Oh, price of per share.
Price of per share and the number of shares, right? Let's say the number of shares is 1 lakh, right? Let's say total number of shares 1 lakh. And the price is 500 of that stock. That means that the company is having a company's capital of 500 into 1 lakh, which is around how much? 500 lakhs approximately. 5 crores. 5 crores, right? So that is how you can calculate the value of a company, the company's share, or you can call it as a company's share capital, right?
Okay.
And the stock price can change based on many factors. So that could be, I will explain you those factors. Okay, so see, the price of a share can change based on many factors. So there are 3 things. One is fundamental. Second is technical. Third is sentimental. So what is sentimental? Sentimental means news, based on the news, right? So if there is a good news, the price of the share may increase. If there is a bad news, the price of a share can decrease, right? So this is more or less related to any kind of news is coming. Now these days you can see that there is a lot of tariff wars news which is coming from US, right? So that may impact the price of the shares.
Okay. Because of US increasing the tax, European countries also have increased their tax.
Yes. Because see, some companies who belong to India, they may do some kind of export and import from US and other countries also, right? So they may they may have to pay more tariff and more tax, right? So that is why the stock prices may fluctuate based on this tariff war, right? So this is.
So they're telling it have a really bad impact on stock market.
Right. So this is what is called as sentimental or news-based thing, right? So nobody has any control on this type of thing. news based, right? So what we have to do, we have to wait and watch what is happening. Right? Second thing is fundamental. Fundamental means based on the companies, how the company is doing, right? How the company is doing the sales, how the company is generating the profits, right? All those things. So those things come under the fundamental thing, right? So based on the every quarter they will declare some results, right? How they have done in the previous quarter, how they have improved your sales, what is the assets and liabilities. All those things will come as a part of fundamental. So those things will also impact the prices of the stock. Okay. And then we have technical, which is the thing which we are going to talk about in the basically the classes, right? Technicals is like kind of we have to read the historical data.
Okay.
Based on the historical data, we have to predict how the stock prices can move in future. So this is called as technical analysis. So like as you have seen that these government they do weather forecasting, right? So how they do weather forecasting? Do you have any idea?
No, based on the satellite system.
So based on the historical data, they will do the weather forecasting. They will see like 5 years or 10 years data that let's say last year in the month of May they have seen like the temperature has increased to 40 or 42, right? So they will analyze the data for the back history of 4 or 5 years, and based on that they will decide what is going to happen in this year, right? So similar thing in the stock market also, based on the historical data means there are two things, price and volume. So based on the price and volume, we will see the historical data, how it has behaved in the past. So we will expect a similar kind of behavior in the future also. So based on that data, we have to predict the future price movement of the stock. This is called as technical analysis. Okay. So this is a basic definition. So now I will tell you about mostly about the.
What was fundamental again?
Fundamental talks about mostly the sales of a company, the profit he has made, right? The tax he is going to pay, mostly about the sales related thing, and how much asset they have, how much liability they are having.
So that comes under the growth stock which you told. They check every quarter and they keep replacing the companies.
That is, you can think like you can consider growth from that point of perspective. But these are the different ways to predict the stock prices. Anyone can use. For some people are using fundamentals only. Some people are using technicals to do the stock price predictions. Some are following the sentimental only. So these are different ways or tools, you can say that, to predict the stock price movements. Right. So we mostly will be talking about the technical analysis. Okay. 1 second, I will explain you in detail about technical analysis. So still these things are clear, right? Any doubt till now?
Yes, got it. So what we are going to look up into is technical analysis.
Technical analysis, yes, correct. See, these are the types of analysis we have to follow to see how the price of a stock is moving or how it will move in future, right? So this is based on the charts and patterns. Fundamental is based on the profit and loss statement, price to earnings, sales, quarter, sales, assets, liabilities, all those things, right? And sentimental is news based, right? So technical analysis is a way to predict price movements by examining or checking the historical data, mainly price and volume. So price means each stock is having a price, right? I have told you just now that each stock will have a different price, right? So that is basically the price of each asset or each stock, right? And the volume. Any idea about volume? What do you understand by volume?
How much that company hold?
No, volume means like the number of traders or number of trades, buy and sell. Because in a trade we have only two things, right? Buy and sell. That is it. If one person is buying, the other person has to sell. So there has to be a sync, right, to complete a trade. So this is called as a trade, buy and sell. So volume basically comes from the number of buyers and number of sellers.
Okay.
So based on the number of buyers and the number of sellers, we have to see the volume. So there are certain tools to see how much was the volume in history and how much volume can come in future like that, right? So there are different tools that we will talk about. Okay. So this is basically we have to see only the price and volume. That is it. Okay. And this has to be done via charts and patterns, right? So this you can relate with an example of, let's say you want to learn a new language, right? Let's say you want to learn a French. So first you have to learn about the alphabets, right, which are being used in that language. Based on that, once you learn the alphabets, then you have to learn the words, and then you should start forming the sentences. So similarly, technical analysis is also kind of language that we are using to find the stocks prices in future, what is going to happen, right? In technical analysis, there are different tools that we can use to do the technical analysis, which is called as charts, patterns, and indicators. Okay. Charts, patterns, and indicators. So these three are the things that we are going to use. So these are different tools. So we have to use these tools. Why we have to use these tools? So that we can increase the accuracy or probability of our trade, right?
Yes.
So you must have learned about permutation and combination probability and all those things, right? So this is a kind of probability only. So there is no 100% here. We have to, our main target has to increase the accuracy of our trade, right?
And these tools help us to
increase the accuracy. Yes. So there are different types of traders some traders are having 50 to 60% of accuracy. Some traders are having 70, 80% of accuracy, right? So it depends on how they are doing the analysis, what tools they are using to do that analysis, right? Fine. So these things we can use whether we want to do a trading or we want to do investment. So these tools we can use it for trading and investing. Okay. But in fundamentals we cannot use for trading purpose. We can use only for the long-term investment, fundamental analysis. But technical analysis we can use for trading as well as investments. Okay. Going to talk about the types of instruments which we can use in financial assets under stocks category. Okay. So we have cash stocks, which is called as equity cash. Is you have heard about certain companies, right? HDFC, TCS, Reliance, State Bank, ICICI Bank, right? So these comes under the equity part, or you can call it as a share or a stock, right? Then we have indexes or indices, which we spoke in the first class, right? Indices. So apart from Sensex, we have Nifty 50 and Bank Nifty, and there are many other indices. You might have seen on those websites, right? NSE India and BSE India. So there are a lot of indices available. Right? Then we have currency to trade, right? So in India, we have a currency to trade in pairs, because like pair means bond and INR, JPY and INR, and USD INR, right?
What is JPY, sir?
It's a yen, Japanese currency.
Okay.
Right. So we have to trade in pairs. So there are some traders who trade only in currency. Some traders they just want to trade in equity. Some traders just trade in index. So you have different varieties or different flavors wherein you can choose and try to do the trading or investing. Right.
Yes.
Then we have commodity like gold, silver, crude oil, natural gas, all those things, right? And then we have ETF. ETF is called as exchange traded funds. Have you heard about ETF, exchange traded funds?
No, sir.
So exchange traded funds are basically the basket of the stocks. So there are many things available in the ETF. Let's take an example of Nifty 50. So for Nifty 50 also they have an ETF, right? So you cannot invest directly in Nifty 50. If you want to invest in Nifty 50, either you have to go through ETF route, or you can do it through mutual funds. There are only two options wherein you can invest in Nifty 50. You cannot invest directly in Nifty 50 you can trade in Nifty 50, but you cannot invest, right? So you always have to go through the ETF route or mutual fund route to invest in Nifty 50. Okay.
Yes.
So this is basically the underlying asset of Nifty 50. Okay. Similarly, we have for gold, right? Gold ETF. Let's take an example of gold ETF. Okay. So if you want to invest in gold, what you have to do? You have to go to a shop and buy it, right? Maybe 1 gram, 5 gram, or 10 grams, like that, right? So this gold ETF executes or runs based on the raw gold only. The price movements will happen based on the raw gold only in gold ETF. So instead of investing directly in gold, you can invest in gold ETF.
Okay.
Because here you can buy in one quantity, right? So the price of gold ETF is 85 rupees. So that is 85,000, right? The gold is 85,000, right? That is for how much gram? 85,000 is for how many grams?
10 grams.
10 grams, right? So this is 85 rupees. So this changes based on this only. But the only benefit here is that you can invest minimum one quantity here. You can buy minimum one quantity here, gold ETF. So that is the beauty of gold ETF. You should not be investing 85,000 minimum here, right? So that is why the government has launched gold ETF.
Okay, you can buy one quantity or how many ever you want. Not necessarily in physical terms where you have to.
Where you have to invest minimum, if you want to buy 10 grams, you have to invest minimum 85,000, right? Or if you want to buy even as 1 gram also, then you have to invest 8,500, right? Plus you have to pay some GST and VAT also, na? So here you can buy one quantity in 85 rupees. But the prices will change based on this price. This is called as the underlying asset. Gold is the underlying asset for gold ETF.
Okay.
Okay. So the only thing is that here you have to invest through stock market. Similarly, we have silver ETF also. Similarly, you can invest in silver ETF also.
Okay, sir.
Like in Nifty 50, the price is 22,500, right? Nifty price. So the
Yes, sir.
ETF price is around 240 rupees. So this is how they have designed it. So the price, this price will change based on the change here also. This is directly linked to
this. There will be a change in total.
Yes, this is directly linked to this. The only benefit they are giving to the investors is they can buy in minimum amount. Yeah. And this you can keep it for long term also, like 4 years, 5 years, 10 years, 15 years, 20 years also, like that you can keep it. Right?
Okay.
So that is a concept of ETF. So this you can call it as a, in terms of gold, you can call it as a digital gold, or you can call it as a digital silver, right? You can call like that. Because you are not holding the raw gold or raw silver. You are holding the gold and silver in your demat account.
Okay. But once we sell it, we get a price.
Yes.
Which.
Let's say you are investing 1,000 rupees, 1,000 quantity at 85 rupees. Okay. So you are investing basically 85,000 rupees, right? So after 6 months or 1 year, once the price goes to 90, then you can sell it. You will get 90,000 rupees. That is a profit of 5,000 rupees.
Okay. But there's always been a growth in gold ETF, no, sir?
Yes. Because the prices will change based on the gold price only. If the gold price goes down, the ETF price will also go down. If the gold price goes up, the ETF price will also go up.
So now let us assume we are assuming that 1,020, sir. And for 85 rupees, so 85,000. What if the price goes down for 80%?
Then it will show you loss. Then it will show you loss in your demat account.
That is not the right time to withdraw it.
Yes, you have to wait to come in profit, because gold is not like a risky thing, right? After 1 or 2 years, gold will definitely give you profits, right? So you have to hold it for long time. So some people do trading also in gold ETF. Trading means they will see the supply and demand based on the technical indicators, right? We just focus on the technical analysis, right? Based on the technical analysis, we can predict when the gold price is going to increase. Right? So that is how we use technical analysis to buy gold, silver, stocks, and everything. So because without technical analysis, how we can decide when is gold price going to increase? Either we can decide based on the news only, right? Once the news comes, then only we can think that the price may increase or decrease. But here, analysis will tell you in advance whether the price will be increasing in future or not, and how much will it be increasing like that. Right? So last year when the gold was 70,000, I have done some kind of technical analysis, and at the time I have purchased actually at 70,000. So it went to I predicted that it should go around 1 lakh, but it came from 92,000 back. So at the time I have purchased, and then I have sold it at 90,000.
Oh, okay.
Okay, so like that you can
20,000.
So like that you can use technical analysis and you can earn profits. The only thing is that you have to wait and watch what is happening, right? You need to have patience also, right? When you are investing. Fine, and then we have mutual funds. So mutual funds is similarly to ETF. The only difference is mutual funds are being managed by the fund manager. So fund manager may be of different companies, right? Like ICICI, SBI, or Kotak Securities. They have a dedicated fund manager who manages the mutual funds, right? So indirectly, the mutual funds will invest only here only, right? In these places, indirectly they will invest. But the only thing is that for you, it is like you don't have to do any kind of more deep analysis, right? You can just do the basic analysis and you can give your money to fund manager, and they will do their deep analysis, and they will invest based on your requirements. Right? So these are the instruments that you can trade and invest in the stock market. Apart from this, there is one more thing called IPO. I think IPOs I have explained you in the first class, right?
Yeah, when you are there in the primary sector, after you go to the secondary.
Correct. So this is one more instrument which you can use it to earn profits. Right? And so these are all the instruments. Is it clear to you? Any doubt?
Yes, sir. No, sir, not really.
So it is your choice which one you want to choose. It is not like that it is an hard and fast rule that you should choose any specific thing. It is your choice. You can choose any instrument, or if you want to choose all the instruments, you can use all the instruments to trade. I mostly use like 70-80% I'll use equity, ETF, and indexes. And this I use for investment purpose, mutual funds.
Sir, but since you are eligible to do deep analysis, do you still invest in mutual fund?
Yes. Because I don't want to touch that fund for a long time, right? I want to invest for 15-20 years.
Okay.
See, the stock prices will keep on changing. It can go up and down like that. But mutual funds has very less volatility, right? They may not come down immediately, right?
Yes, sir.
That is why you should distribute some of your money to invest in mutual funds also for long-term targets.
Okay.
So you can choose these and you can trade. And this clear?
Yes, sir.
Now coming to the market timing. So what are actually the market timings? So market timings are different for different instruments. So for equity, cash, and index, it is 9:15 to 3:30. For currency, it is 9 to 5 p.m. and for commodity, is 9 a.m. to 12 p.m. Sorry, 12 a.m. in the night. Approximately 15 hours.
Oh, so that is like almost like full time open. I mean, half a day.
Full day mostly. Now 9 a.m. it will start and it will go to 11:50 p.m. or 12 a.m. at night. Almost 15 hours. So the least time is for equity, 9:15 to 3. Okay. now we have the types of stocks, right? So earlier we spoke about the different categories of stock, right? Growth stock, blue chip stock, defensive stock, all those things. Now we have a types of stocks, how they have segregated the stocks based on the capitalization, right? Share capital, based on the share capital, how they have segregated, right? So there are basically four types of categories: large cap stocks, mid cap stocks, small cap, and penny stocks. So this is totally based on the share capital, right? So the companies which are having the market capitalization or share capital of more than 20,000 crores, they come under the category of large caps. Right? The mid caps will range from 5,000 to 20,000 crores. Small cap will range less than 5,000 crores, and penny stocks are less than 100 crores. Right. So this is a category they have decided. Okay. So now you see from the large cap point of view, normally I have seen that this will give you a return of 12 to 15% per year.
Large cap.
Right. Mid cap is like 25 to 30 or 35%. Small cap may give you more than 50% return. And the penny stocks may be like 100%, 400%, 500% also they can do penny stocks like that. But these are the large cap are the least risky because they are basically the growth and blue chip stocks.
Okay.
Mid cap are medium risky, small cap are more risky, and penny stocks are the highest risky. They can become zero. They can become zero also. Small penny cap stocks they can become zero also, and they can give you 100%, 500% return also.
So you will be investing. You are investing in all of it.
I invest some percentage. That we will talk about how much percentage we should invest in each stock. So, as a normal rule, you should invest 50% in large cap stocks, 25% in mid cap, 15% in small cap, and 10% of the capital in penny stocks. Because these two categories can become zero also, right? And in mid cap, you can see at least minus 50% of correction also. But in large cap, you can see maximum of 20 to 25% of the correction. See, we are talking about return, right? So we should also know about the risk also, right? So it depends on how much risk you can bear in the market, right? So this is the best percentage that you can follow. But if you are a high risk trader, then what some people will take 50% in mid cap, some people will do like 30% in small cap, and remaining they will do in large cap. So this percentage you can change based on your risk appetite. This is not like hard and fast rule, but you can change it based on your risk appetite. I mostly invest in mid cap and small cap.
Okay, but